Hello, hey guys. Today I want to come on and I want to speak a little bit about different types of investment strategies and how they can work even when there is uncertainty going on in the economy and in the world. I'm just going to hit share on my Facebook page. Okay, great. So right now, what's happening is that there's a lot of uncertainty going on in the economy. And it can feel like maybe this time it's different. And maybe it is a little bit different. I mean, the pandemic makes things very, very different. We haven't experienced, most of us haven't experienced anything like this in our lifetime. But the economy always goes through cycles and we never know where we are in the cycle, whether we're at the bottom, the top, the middle, and trying to decipher what is going to happen in the future is a very dangerous game to play, especially when it comes to managing your money. You might not even know that you're doing this. Even saying things like, oh, I'll do it, I'll start investing later when things become more certain. Even that is you preempting what you believe is going to happen in the future. And ultimately, if you are invested in cash and only invested in cash, that is a sure way to lose money. And I'm a big advocator of having enough cash that you're able to support your short-term goals. So these are things like lifestyle goals you have, and your medium-term goals. So these are things that maybe happen periodically, like going traveling or personal development, things that you know you pay for each year, or you have something coming up in the next 5 years. Maybe you want to upgrade your car or do renovations or something like this. Never, ever, ever use investments to pay for these types of goals. Never. Any time that you have a goal that is, I would say, even less than 10 years, you don't want to be investing in the share market, because you are essentially then needing to have a crystal ball to know what is going to happen in the next 10 years. And we don't know. What we do know, and this is only based on the past, and of course the past is not a great predictor of the future, but it's the best that we've got, especially when we look at the share market, because we have a lot of data, right? It's been around since the late 1700s. So when we look at this, we know that there are economic cycles. We know that that the market goes up and down. And typically in the past, the cycles have gone, from 1 to 7 years, where it goes like this. Now it looks like it's extending from around 10 years. So we want to be invested for at least 10 years to de-risk our investment, to de-risk our portfolios. If we're investing for less than 10 years, then we are essentially trying to time the market. We are essentially trying to time the economy, and we don't know where we are in the cycle. We don't know what is going to happen. Yes, we can make some kind of predictions, but I was in finance for over 10 years. I worked with the most well-regarded fund managers in the world, the most well-regarded economists in the world, and they got it wrong most of the time. They are so intelligent. They dedicate most of their waking hours to this, and they get it wrong most of the time. So to think that we can try and predict what is going to happen in the future, to think that we can predict what is going to do well, what isn't, what companies are going to do well, what companies are not going to do well, is really futile. And you might get lucky a few times, but over the long term, the average person, and even the professional investor, even the guy who went to the Ivy League school and has been working in finance for 40 years, and is managing money, been managing money every day, even they are more likely to actually lose money when we're investing as an active investor, when we are trying to essentially beat the market, when we are trying to time the market. So how to build a recession-proof investment portfolio? How is this possible? And I'm going to throw you a curveball, because if you ask a fund manager, they would say, oh, you can go into the types of assets that are not correlated to the economy. Or you go into the types of assets that have an inverse correlation. So that means that they actually do the opposite. So when the economy is doing poorly, these types of assets do well. So that's an inverse correlation. Assets that are not correlated is assets that have absolutely no alignment, no correlation at all with the economy. There is no pattern there. So you could go into these two types of assets. These types of assets tend to be difficult to access, not all the time, but they tend to be more difficult to access, which also means that they're not as liquid. They tend to cost more to do transactions with. So let me give you an example. Gold, for example. This is a commodity that often people will say when the economy is not doing well, or if you want to safeguard your investment portfolio, invest in gold. Gold, over the long term, over the last 100 years, has done 1.1% per annum. 1.1%. That is less than inflation. If you are investing in gold and you're keeping your money in gold, you are essentially losing money because inflation is higher than 1.1%. If you look at the short term, yes, it flies up and down, up and down, up and down. It's also very, very volatile. So the share market has a volatility percentage of around 15%. Don't worry that doesn't mean anything to you. But I want to tell you in comparison to gold. Gold has a volatility percentage of 13%. 13% to invest in gold, where you get average return of 1.1% and it's meant to be a safe investment, versus the share market, which gives you on average a return of 9.8% over the last 100 years if you invested just in an index fund, and it gives you a volatility of 15%. So you're taking 2% more volatility and you get a return of 9.8 of 8.7 higher percentage higher than gold. These types of assets that are used to hedge in a recession, they are typically not that effective. You can also use derivatives. We use them sometimes, but I never saw them to be effective. The most effective strategy to make your investments recession proof so that they will make money for you is not about investing in a different asset class. It's not about trying to time the market and pull your money out and put it into cash and buy gold. It's not about buying crypto. Definitely not about buying crypto. It is about staying in the market. What? That might sound so strange. Why would you stay in the market? Why would you stay invested if there is uncertainty and there might be an economy downturn? Because the best days in the market are directly after the worst days. If you pulled your money out during recessions, you would have an average return of 2.8% versus 9.8% if you just stayed in. So this is why investment education is so important. So you can actually zoom out and you know the statistics, you know the averages, you know how it works. You don't freak out when your portfolio loses money. You only lose money when you sell. That's when you lock in the capital losses. It's only when you sell. I don't look at my portfolio, ever. Maybe, if I'm at a cafe or something and it pops into my head, maybe once a month, twice a month, I'll go in and look at it. but I have no needs. I'm not emotionally attached to it. There's no decisions that I need to make because it's all on autopilot, because I understand how the market works. I understand that as a passive investor, that I will, over the long term, get an average return of around 9.8%. But I have to invest for forever. And when I say invest for forever, people are like, oh my God, why forever is so long? What's the point? What is the point if you're investing forever? Because what you are doing is when you invested in the share market, you are buying a part of a company. When you buy a part of a company, you become an owner. That means now you get to share in the profits. So when that company makes money from selling whatever it sells, it will reinvest some of that money, and it pays some of that money to shareholders. Me, income, passive income. So even though you're investing forever, you start to get income paid out to you from these companies because you're a shareholder. And eventually, when you build up a big enough portfolio, which if you do it the way that I teach, just a few $100s a month, you can be a millionaire. It takes time. I'm not selling get rich quick. It doesn't work. Get rich quick does not work when it comes to the investment market. If you're trying to get rich quick in the investment market, you will eventually lose a lot of money. You will lose a lot of money. If you want to get rich quick, do your soul work, do your art, create income, do money mindset, open portholes for money to enter into your life. Don't use the investment market to get rich quick. That is out of your control. It's not something to play around with. It's not something that you just, I read a sentence the other day and was like, if you want to learn how to fly, you don't just get in a plane and start flying and just say, oh, I'll wing it along the way. No, you learn how to fly first. And that's the same with investing. I mean, you can get it right in the plane and you might crash it. For me, money, I want to treat it with respect and with care. I worked for this money. I brought this money in, and now I treat it with care. Over here, I'm bringing in income. I'm taking risks in my business. I'm calling in large amounts of money that way. I'm creating a business that's bringing in 500% per year in growth. I'm never going to get that in the investment market, and I don't need to, because I opened that door there where I'm backing myself. In the investment market, I don't control it, and I don't have a magic ball into the future, and it doesn't work. People who think that they can actively invest, they don't perform well. Over the long term, they don't do well. And so it's totally unnecessary, because then when you take care of your money and you invest it over here and you keep it in there forever, and then it starts producing this passive income, you don't need to be taking huge amounts of risk and investing in random assets and listening to what your friends or your parents or what your family are telling you to do. You don't have this thing of fear of missing out, because you understand how the market works, and you have a strategy, you have a philosophy in place that is based on education, and you have automation set up that is building that for you. So how do you build a recession-proof investment portfolio? Is that you invest in good quality businesses, not assets that are just based on what someone else would pay for them. Crypto is one of that. Cryptocurrency. It's an asset that has no underlying value. It's not like a business. It doesn't have cash flow. It doesn't have a balance sheet. It's not selling anything. It's not a service provider. It's only worth what someone else is going to pay for it. It has no underlying tangible value. That is not where I want to put my money to invest. And it's not necessary. Yes, some of my clients do invest this way, but they are prepared to lose that money, and maybe they make a lot of money as well. But this is their gambling money, 10% maximum to invest in this way. But you don't need to take a gamble. You can actually invest, and everybody can do it. Really, everybody who's watching this can do it, and they can start now. It's not something that's difficult. It's not something that's out of reach. And it's the only way that is actually going to create financial independence. I've never met, and I worked with a lot of really wealthy families. all of them invested in the share market. They didn't wait until they had a lot of money to start investing. That's how they made a lot of money, right? Because they were investing. That's how you build wealth. You don't wait to build wealth until you're wealthy. You start acting like it now. You start treating money with respect right now and understanding it and investing it right now. And you really don't need a lot. Like I said, you know, even $50 a week makes a huge difference. Huge. But you have to be committed to staying the path. And that's what most people don't do. And that's why most people don't have recession-proof investments, because they're so focused on what is going on right now and what will happen in the next year, 2 years, 3 years, 4 years, even 10 years. It's irrelevant. It's totally irrelevant. And that's how you build a recession-proof portfolio. You stay invested, you invest consistently. This is called dollar cost averaging. And when you do that, it doesn't matter if the market is, if it's high priced or low priced, because you're investing consistently. So you're going to average out the price you buy in at. So you're reducing risk that way. So how to build a recession-proof portfolio is you learn the fundamentals, you learn the averages. It's really basic. I mean, I studied this stuff at 4 years. I studied it at university, and then I did 3 years post-grad, and I worked in the industry for 10 years, and so much of what I learned was so complex, and it has a place, but it's not necessary in order to build wealth. It's really not necessary. There are simple, fundamental, foundational pieces that I pulled out of that are really effective, and they're really easy to put in place for everybody. And I urge you, if you haven't started to look at this, to start looking. Not start looking, to start doing. And to start creating a financial foundation for yourself. It's so important if you want to be financially free. If you don't want to have to rely on the government pension, if you don't want to have to stay in a marriage, you know, want to be in relationships for love, then you also to work, that you get to work for the joy of working, for the art of it, rather than doing things for money. And to me, that is freedom. So this does create freedom because it frees you up to be more of who you are, and you stop asking permission from money, and instead you're making decisions based on your own inner pleasure, based on your own commands, your own direction. So that's what this can do for you. So I have Invest Like a Queen. I've just re-recorded it, and it's amazing, amazing, amazing. It's an incredible program that teaches you the foundations of investing, and it teaches you actually how to manage and build your own investment portfolio. I'm going to drop the link in the comments above and below. It's open now. I give you it in bite-sized pieces, and I'm also there available for you if you have any comments. So I'm there to support you throughout the program as well. All right, reach out if you have any questions. Sarah said, thank you so much for your time. You explained this so well. You're amazing. Thank you so much, Sarah. I love talking about this and explaining this. I think it's such important information, and it's something that everybody should know, and I can't believe that we're not taught this stuff. So that's why I'm doing what I do. All right, I'll see you all later. Bye.